Hey, everybody, welcome back to We Talk Money. This is month 2 of quarantine, and we have a lot to talk about today. First, we're going to jump into talking about the broken oil markets. Something unprecedented happened yesterday, and things just keep getting weirder even today. And we'll talk about what happened, dispel a couple of the myths around that, and talk about really what to do in the oil markets going forward. We're also going to talk about China's fake digital currency that keeps on gaining traction. We'll also talk about Bitcoin and the halving that's coming up and why I think Bitcoin is primed for a big move. Then we're going to kick it over to Nikki, our resident CFP, who's going to talk about the next round of stimulus that's coming, and this is going to be especially helpful for any entrepreneurs that are in the U.S. And then we've got just a whole range of news topics that we're going to do kind of a fire round through, and we're going to answer your questions. And as you can tell, I'm rocking I call it the COVID hawk, because
I was going to say, we need to talk about Chris's mohawk.
Yeah, I couldn't get to my barber, and I was like, well, hey, why not just mix things up and have some fun while we're here locked inside?
I love the mohawk for one, and I'm the only one that matters. So,
well, I appreciate that, Nikki. And why don't we do this? Let's go ahead and jump right into it, because we've got a ton of stuff to run through today. Trav, I'm going to kick it to you, man, to talk about the oil stuff, because you got ahead of this yesterday. People on my Twitter feed were just freaking out and sharing all kind of misinformation. And you can't blame them, because most people don't understand how futures actually work. So why don't we start there, just talking about the oil futures markets, what happened, how they work, and maybe what people can do going forward, if anything, in these markets.
Yeah. Wow. You're right. An absolutely just mind-blowing occurrence yesterday in crude oil markets that we had never seen before. A historic occurrence, really, but a little bit misleading as well. So first of all, the headline said, crude oil traded to a negative price. It traded down to negative $40 a barrel. People didn't really understand how that was even possible. But I was out there tweeting about it, saying, hey, listen, ignore the headlines, because it's actually a little bit misleading, because really crude oil, if you want to buy crude oil going out into the future, is not really trading at a negative barrel price for the most part. It was sort of I guess you could call it just an anomaly with what was going on in the front month May futures contract, which was actually expiring yesterday. So, I made a video on YouTube kind of explaining all this, but to summarize it, basically crude oil futures have different months that they expire in. So you can buy crude oil or sell crude oil out into the future, whether it's next month or 6 months from now or 12 months from now. And those contracts expire. And if you can't take actual physical delivery of the oil, then you need to roll your contracts into future months. So most of the players in the market had already rolled their contracts into the June months for crude oil, but that May contract still had a few people trading it yesterday, right before it was about to expire. But here's the problem. If you own that contract going into expiration, then you actually have a requirement to take delivery of that oil at a very specific place in Cushing, Oklahoma. And you have to either have a pipeline or you have to have a storage facility. You can't just take this stuff into your swimming pool or front lawn. And so what happens
like many people thought.
Yeah.
So I can get free oil delivered to my house. Bring it on, baby.
Right. Yeah. It seems like a good idea to try to buy crude if it's trading at a negative price. But the problem is all the buyers disappeared in the market, because you can't actually take delivery because storage is full right now. We have an oversupply of oil due to the coronavirus shutdowns. And so all the storage is mostly full, and you can't really even take delivery. So the buyers just kind of disappeared, and the other people that were holding the contracts may have even gotten liquidated or margin called, which made that sell-off even worse. So that's how we got such a deep decline in the prices. But like I said,
just to kind of do like a high level overview of like what futures are for people that don't understand this, because it's kind of a weird concept, right? It's like, what do you mean? If I buy oil, can I just own it like an ETF? But the weird thing with futures and options is they have expiration dates, right? So it's like if you're long this contract that is ending on a specific day, you either have to sell that before the contract expires or actually take physical delivery. And I guess what happened is so many people were stuck with these contracts saying, I'm going to actually have to take physical delivery, which I actually can't do. And so with everybody selling, they actually had to pay somebody. And that's how the prices got into negative territory.
Yeah, that's right. And so one of the unique things too about the oil futures is that there's that physical delivery requirement. So yeah, there can be really strange things. And the other thing about futures too is that they're leveraged products. So you have to, be aware that you can get margin called or liquidated if you're holding these and they go down enough. So that's part of the problem. When we looked out across the futures curve, like you're showing here, prices per barrel were still above $20 a barrel for most of the months going forward. It's just really what happened with that May contract. Now, today, what we're seeing is the front month contract is now the June contract, and that expires in a couple weeks. But traders are already front running the expiration of that contract because storage is probably still going to be full when that contract expires. And so people are already starting to roll out of June or even short the June contract, knowing that there's going to be a similar thing that could happen to the June contract as to what happened in the May contract. So that's why we're seeing the June contract down over 60% today. And this actually has ramifications for other products that have exposure to crude oil, and specifically USO, which USO is an ETF, a very popular ETF that gives people exposure to crude oil futures without them having to actually buy those futures themselves. So what USO does is it actually goes out and buys front month crude contracts actually in the first forward month and then in the second forward month. So we could pull up the holdings and you'll see that most of what that fund holds is June crude futures contracts. They didn't get caught in the May contract. They had rolled as of last week, like most big players. But now that June contract is down a lot, and they're sitting on a pretty massive holding. So a lot of retail investors were rushing in to buy USO to try to get exposure to these low crude prices, not really understanding that USO actually holds higher price crude contracts that were a little further out. And now those contracts are actually down a lot. And there's also another problem with contango, meaning USO next month has to go out and buy more expensive futures contracts. So there's all these implications with USO, and what is happening at the end of the day is USO is losing all of its value. And I actually think it could be liquidated this month and go to zero.
That's actually very interesting and kind of scary. It basically means that the oil markets are kind of broken right now. Like they're not working as they should be. When you have markets going negative, that obviously that was like a weird one-day scenario, which quickly got quote unquote fixed. But the issue with, an ETF that could get liquidated or go completely bust because of this is kind of a contagion or just like a waterfall of problems that could continue in this market, right?
That's exactly right. Yeah. So I cautioned people at the end of my YouTube video yesterday, do not try to go in and play crude oil futures right now because the market structure is extremely problematic. And even the ETF like USO could actually end up going to zero in the short run because it may not survive the current market structure. So
that is crazy.
Yeah. It's also crazy because USO is the most actively traded stock or ETF in the market over the last 2 days. So there's a lot of...
Give me this link for what's Robin track. So this tracks the popular, or I guess the user holdings is the green line.
Yeah.
Showing that this was like the most traded asset over the past couple of days on Robinhood.
Yep. So, that shows Robinhood specifically that there's a lot of individual investors that rushed into USO. I'm guessing that a lot of them saw the crude oil price decline in the May contract and thought that meant that crude oil generally was getting so cheap that they wanted exposure to it because they're like, oh, oil will eventually recover. But what they don't understand is that USO doesn't give you long-term oil exposure. It gives you exposure to the short-term crude contracts over the next 2 months. And, USO is obviously a victim of what's going on in this short-run market. So USO is not a good way to play long-term oil prices. Even if you were to actually go out and buy futures on oil 12 months or 24 months out, you're going to pay a much higher price per barrel. In fact, I'm looking at the 2021 and 2022 crude contracts for January, and those trade above $30 a barrel. Yeah. So it's not like you're getting $5 per barrel crude if you're going out further on the curve. The market is already pricing it higher because the market knows that the supply-demand picture will get better for oil over a longer time frame. So there's really not a good way as an individual investor to buy oil at $5 and hold it until it goes over $30 a barrel right now.
So, and this is where there's kind of a weird scenario in the markets. You have two major players in the futures markets, really. You have hedgers, right? You have oil producers and people that are actually in the oil business. And then you have market speculators, right? And that is kind of creating this weird dynamic where it's almost like the speculators are kind of fucking it up for the hedgers that are actually trying to create a market where they can keep the supply going of oil. But obviously, I mean, it's kind of the storage, I guess, is the major logistical error, right? Or problem is that, like, look, the demand for oil has gotten slashed massively, but the supply kind of keeps coming, and now storage is full. I don't know. How do you see this playing out on like a real world basis?
Yeah, so I think the CME is going to be forced to perhaps lock down trading in these contracts unless you're an actual producer or consumer of crude oil, because again, these are physical markets and we've got all these financial speculators that are playing in this market. USO actually accounts for like 30% of all the futures contracts now, at least in the front months. And so these weird liquidations that are happening are affecting the real producers and consumers of these products. And I think the CME is going to have to restrict trading in these contracts in the short run potentially, because we have to have functioning markets for the producers and consumers of oil. You know, when we talk about the storage issues, that will eventually get worked out because we're going to have supply cuts and then demand should return when we all get back to actually having a functioning economy again.
Yep.
But it's going to take time. Now, one interesting way that investors have been playing the storage is through things like the tanker stocks, because a lot of the shipping tankers are being used to store oil for the short term. And so the rates for tankers have gone up dramatically. So you've seen the tanker stocks, stocks like Scorpio Tankers or TNK or Double Hole. So there's a bunch of STNG would be a ticker, or DHT or TNK. You've seen these stocks really start to move up over the last couple of days with this increase in tanker rates. So I'm not saying you should rush into tanker stocks because they're not exactly the best long-term businesses, but you are seeing the knock-on effects of the essentially shortage in supply, or shortage in storage.
Yeah, it's a very weird scenario. And one thing that I can just give a little perspective on is, so I used to actively day trade the futures markets in oil and gold and stock indexes. And the one weird or the one thing that we would not do is trade contracts that were in that kind of weird period in between rollover and expiration, because you get kind of these weird scenarios. I mean, I never traded a contract that went below zero, but you know that funky stuff can happen. And so for anybody that is actively trading the futures markets, you just got to really keep that in mind. And especially if you're, understanding the risks of, if you're speculating and you're buying a contract several months in advance, hopefully this is kind of a wake-up call of the risks that actually come along with futures. Yeah,
I would just add to that especially in the crude oil futures market, the counterparties to your trades are very sophisticated entities. You've got energy producers that have trading desks. You've got airlines, hedge funds. You've got lots of people who know this market very, very deeply. And so if you think you're going to come in as an individual investor, tourist, as we call it, and somehow make a killing on crude oil, well, you're probably mistaken.
Yeah.
So.
Awesome. Well, thanks for sharing that. I know, again, yesterday, Twitter was just a shit show of people that were really not understanding what was going on. But I think that the fact remains, like, there is still a ton of risk, and this could actually get weirder. And probably the best thing for your average investor is just to stay away from this space unless you know it intimately and you see an edge on one side of the market. Okay, cool. So next up, let's talk a little bit about crypto. This is something that I actually tweeted, was it this morning? Yeah, this morning. So the Wall Street Journal just put out an article talking about China's rolling out their pilot test program of their digital currency, which I call a fake country digital currency, right? And this is something that I think is one of the biggest threats to freedom around the world right now is government-controlled digital currencies, because it's really like, it's fake. It's not a decentralized peer-to-peer digital currency like Bitcoin, right? And like, just read this. This is a little a little snippet that I took from the article. It says China's central bank has said that shifting to a government-run digital payment system will help combat things like money laundering, gambling, and terror financing. How familiar does that sound? And I said, well, so their fake digital currency is basically for the benefit of their citizens. Right. This has nothing to do with control. This has nothing to do, with keeping tabs and just really controlling the system and being able to monitor what everybody's doing and spending their money on. Again, I just think this is a very, very dangerous proposition, and people need to really learn the difference between the three categories of digital currencies. And there's really only one that's real. You have decentralized digital currencies where governments cannot confiscate your value, and you can send money around the world borderless without anybody's spying or permission. Then you have corporate coins like Facebook's Libra, which is kind of a hybrid, but still it's controlled by a centralized entity. And then the third, which is the most dangerous, is government-controlled digital currencies, which basically just masquerade as cryptocurrencies, but really all they are is just fiat currencies with a different tech layer on top of it. So my advice is just be very careful, guys. And, this is some pretty dangerous stuff that's coming down the pipeline. Also taking a look at some crypto charts. So today is April 21st. So we've got just a few weeks until the halving, and you can see Bitcoin has basically been flat. Most cryptos have actually been flat for the past month or so. We really haven't gone anywhere. We've been hanging around that $7,000 magnet on Bitcoin after having a pretty big bounce off of 4K. So the tighter that this range squeezes, for you guys that are watching the video, you can see this range. We're basically putting in a really, really tight consolidation pattern. And so the tighter that gets, the bigger the move when you come out of this range. So coming into the halving, there's a lot of speculation. A lot of people, I think, are just sitting on the sidelines. And you can see that represented in the volume here. So we've had falling.
Can't see the chart, Chris.
Oh, really?
Yeah.
So here's the daily chart for you guys that are watching the video. You can see the consolidation period where, again, back here in mid-March, had a big bounce off of 4K. We've basically been under that $7,000 price point for the past month or so. So, basically, eyes are all on this zone, and as soon as we get a breakout one direction or the other, expect a waterfall of trading activity, which could really give for some awesome opportunities for traders and investors. And pretty much every other crypto has been following this. If you just look at, a leaderboard, we really haven't seen any major changes in the top 10 or 20 cryptos over the past several months. Everything's just kind of moving in concert with each other. And so that's not necessarily a good thing. I like to see if there's an altcoin that is actually trading in its own rhythm, right? But really everything's just kind of following Bitcoin leading up to this halving. So we'll see what happens there. So that's crypto. Next, Nikki, I want to kick it to you, and we can talk about the stimulus packages and what's happening, because I know in our community we have a lot of entrepreneurs that have both been benefiting from this, and some are still trying to get it to work. So what's happening right now with the PPP in the U.S.?
PPP, say that 5 times fast. Yeah, so the payroll protection program has been a point of contention for some people, and it's been it's successful for other small businesses. We've seen actually both ends of the spectrum in our community, where we have small business owners that got approved, they had no issues, and then we have small business owners that got approved, but then they ran out of money, and then we have small business owners that just aren't getting anywhere with this. So it's been a quite an interesting journey for the first round. We're waiting for a second stimulus bill to pass that's gonna provide $300 billion more of funds for these small business administration programs. So includes the PPP, includes the EIDL program, etc. So we're hoping that we get some news on this soon, because there are still a lot of small businesses that kind of have been left out in the cold, especially the mom and pops that thought that this was for them. And a lot of them kind of had some trouble. So it was interesting looking
Nikki, why don't we back up and look at just like what's happened so far? So we gave out money, but then they ran out.
Yeah.
So, and what does that look like? And what does that mean? And where did the money go?
So they, the government basically provided $349 billion to, for small businesses to be able to take out loans through the Small Business Administration. That's who basically administered all of the programs. Mm-hmm. And what happened was within 2 weeks, there were enough inquiries and, from small businesses that the money ran out. So basically, these lenders that were participating through this program had enough inquiries and they approved enough money to where the $349 billion was basically gone within a few weeks.
So there's still a lot of people that are left going, hey, my business has literally no income right now. We didn't plan for this. We're going broke. Help us. And that's what they're waiting on is the next round of stimulus.
Yeah. Yeah.
So what's the point of contention, right? Because I know there's been a lot of backlash at big corporations that are getting bailed out versus small. What do you make of that? Do you have any opinions or perspectives?
Yeah, I think that the data was kind of, it depended how you looked at it, right? Because it was about 75% of the loans were actually for 150,000 or less. So that in theory, that looks great. That means a lot of small businesses got, obviously the average loan was 206,000. That's what the average loan was provided. So that's covering small business for the most part. That's about $82,000 a month in payroll expenses. So that's kind of a big small business if you ask me. But nonetheless, the issue that a lot of people were seeing is they were seeing public companies like Shake Shack, I think Ruth's Chris, and a few others that were actually getting funding. They were getting loans from this program. And if you actually look at the dollar amount of the loans that were provided, about half of the $349 billion was for loans of $1 million or more. So that's a lot of money that went to pretty large businesses.
So big corporations got a big lion's share of the capital, leaving small businesses going, where's my help?
Right. I think the thought process was that the whole $349 billion was going to go more to help these mom and pop, these smaller businesses. And they got a lot of help, but they didn't, obviously $1 million or more in loans. What is that? I think it was about 150 million or something like that, that ended up going to larger companies. So it was about half.
Gotcha. So they're looking to roll out another, 400? Is this right? 300
billion for the Small Business Administration loan programs.
Gotcha. Yeah. And we talked about this in the last episode, the differences between, like bailouts, unemployment, there were several different sections of this. And there was a lot of misunderstanding here too, that really this isn't helping the small person, but it really is. I mean, I've read a lot of stories of people that are like, I'm actually making more money than I was working on unemployment right now. So it seems like there's kind of a wide spectrum of people that have gotten the help they need, that are okay in the short term, and then people that are still just completely left out to dry going, where's my help?
Totally. That is completely true. I've seen both sides of the spectrum. I've seen families talk about how they're rolling in the dough because they're making more than what they made, plus they're getting stimulus. And then there's the opposite side of that spectrum. What's interesting right now is that even though these larger companies were getting PPP loans, like these big corporations, you also have to think about they're employing people. Like this money, even though about 50% of it went, to these larger companies, they're keeping people on payroll. And so those people are going to end up eventually getting off of unemployment.
Yeah.
So, we can be mad about it, but at the same time, it's as long as those businesses take that money and use it for the purpose of keeping people on payroll, and these businesses employ a lot of people, then hopefully people will come out better in the end.
Yeah, we'll just have to keep a close eye on it. So moving on, you guys want to take a look at some markets. We've got, today, let's go ahead and pull up the charts here for you guys watching the video. We've got a lot of markets that have kind of pulled back or are in consolidation mode. So right now, just taking a look at the broad stock indices. So we've got the S&P 500, which basically made a 61% retracement from the lows last month, meaning there was a big bounce, right? And a lot of people didn't quite understand why or how this happened. But if you understand price action, if you understand technical analysis, the picture is very clear. We had an overreaction to the downside, and then we almost had a little bit of an overreaction to the upside, and now we're starting to roll over. Trav, do you want to talk a little bit about maybe some positions that you've made some adjustments to, or your thoughts on where the markets are right now, or maybe even anticipating what you foresee coming over the next couple of weeks?
Sure. Yeah, I think the markets are in a really tough spot at the moment. Sort of like a no man's land area. A lot of my opinions about the market right here depend on time horizon. If you're a shorter term trader, that's a much tougher picture. I think if you were able to look out 5 or 10 years in terms of your holding period, then things are probably a little bit easier. And if you're a stock picker versus someone who invests passively in ETFs, I think the analysis is also different. So for me personally, I'm a stock picker. I do a lot of active investing. That's my background. And I am still finding tons of value out there. I think there's still some individual stocks that are incredibly undervalued, especially when you look
on the other side, there's stocks incredibly overvalued right now too.
That's right. Yeah, that's right. So yeah, I think there's some incredibly undervalued stocks, especially if you're able to look out a couple years forward. And then on the flip side, we've seen, tech stocks rally back to really high multiples. You've got companies like Shopify that were going parabolic this week, trading at 35 times forward sales. And so those were pretty record levels of valuation in an economy that still has a lot of recovery ahead of it. And so I think that people may have gotten a little bit ahead of themselves in terms of chasing some of the popular tech stocks. And I think that probably means we're going to be in a period of some more chop, especially in some sectors like that going forward as we really deal with the actual recovery in the economy. We've got a big week ahead of us. In fact, a big couple weeks ahead of us in stock markets with earnings season. It's really just kicking off with the non-financial companies today. So there's a lot of bellwethers that are reporting this week. You've got companies from Netflix and Google to other companies like Snapchat and Chipotle. And you've also got some travel related companies like the Royal Caribbeans of the world, and then also some airlines reporting. So it's a really, really big time. People are going to be really focused on what the shape of the recovery looks like, the liquidity of a lot of these companies, and valuation, I think, really should matter to you unless you're a very short-term technical trader. So for me, I'm really having to pick my spots. And I actually did add to some of my overall market hedges earlier in the week because I felt like people were ignoring some of the broader risks out there.
So we talked about that. And what do you use to hedge, and what does that mean, just kind of as a recap for anybody that doesn't know?
Sure. Yeah, I've been just shorting index futures, and there's various ways to do that, but you could do something through the E-minis, ES, the MES if you wanted to short like the S&P, or there's other indices you could short as well. But that's really just me trying to cover up some of the broader market risks. I think that even if the market goes higher from here in the next couple of months, which it may very well do, then I think my individual stocks will outperform the market. So I'm willing to actually hedge out some of the broader market risk in my portfolio. Of course, if we go down, that provides gains it provides not only gains to offset some of the losses that could happen in the individual stocks, but it also provides excess cash in the portfolio to make further buys. So it's just a really nice way to, in this market environment, have a little bit of protection. In a normal market environment, I wouldn't be having these short index hedges on because the market has a naturally upward bias direction. So it's really tough to, make money in index hedges in normal market environments.
Gotcha. And Nikki, I think maybe either you or Travis said this. It's like using some of the large cap tech in your portfolio is almost like a hedge because, you know, you've got Amazon, Netflix, a lot of these companies that are seeing all-time highs in their stocks, but also like record sales. And I guess that's some of the stuff that we're going to see in the earnings reports coming up. You know, you've got some companies that are actually crushing it in this time period.
Yep.
That has been an interesting phenomenon, that things like Amazon, I mean, in my own portfolio, Walmart has basically acted like a hedge for me, which is wild.
So what that means is, you know, basically you've got the broad market that's selling off, but you have some companies that are hitting all-time highs. So like a way, I guess, to protect your portfolio is use short hedges or open some kind of managed futures account that can actually profit. And like Travis said, give you more cash as the markets go lower. But you could also, if you are picking the right stocks that are actually going up in this time period, that also helps with the drawdown of the broad market.
Absolutely. Yeah. So I think, you know, I've talked about this in our investing community, but I don't think that I'll have these hedges on 6 months from now. Mm-hmm. But in the current environment, I think it's an interesting way to really give me some comfort and some protection against the unknowable kind of, you know, worst case scenarios that may be out there.
It's nice to have that in your portfolio. Otherwise, you're just kind of sitting there watching the charts going, wow, I hope the markets don't go down. But hope isn't really a strategy, is it?
No.
So cool. So we've talked about stocks a little bit. You know, gold still looking fairly bullish. We had a pullback to the prior breakout level at 1,700. You know, bonds, yields looking very, very heavy. Could break down to new lows. Trav, what do you think? Are we going to negative interest rates?
Well, that's a great question. That's hard to say. I think it's certainly possible. A lot of that's really just going to depend on if we really do get deflation in the actual economy itself. So I don't want to own bonds on the thesis that rates are going to go from very low to negative personally. Yeah. I'd rather buy good cash flowing businesses that I know will be around a few years from now and doing well. So that's kind of my take. I'm not an interest rate guy. Like I'm not an expert in the interest rate market. So I'm kind of looking at it from the 40,000 foot view.
Yeah.
But we've seen it in Europe. We've seen it in certain shorter term bonds. We've seen rates go negative. So it's absolutely possible.
Yeah, very strange time. Let's talk a little bit about some news that has been popping off the past couple of days. You know, we're starting to hear from large entrepreneurs like Richard Branson and some guys that are actually potentially in some really big financial trouble. You know, Richard put out this basically open letter to his employees because Virgin is in some pretty big under some pretty risky conditions. Trav, do you want to tackle this one or talk about what you see here?
Yeah. So, you know, Virgin owns several airline subsidiaries, including Virgin Australia and Virgin Atlantic. And unfortunately, Virgin Australia, I believe, is now going through the restructuring process. They didn't receive any kind of government assistance in terms of loans or grants or anything like that. And with the business being essentially shut down, but also having high fixed ongoing costs, they weren't able to, you know, stay cash flow positive. So Virgin Australia, it remains to be seen whether or not they're going to continue to operate. If they could go through the restructuring process and get new money invested in the company, it could come out of restructuring and still exist, or it could liquidate. We just don't know yet. With Virgin Atlantic, you know, as you're showing here, Richard Branson, he is making a plea to get a loan, not a grant, but an actual loan from the UK government. And, you know, I think there's people on both sides of whether or not that should happen or not. You know, some people are like, just let it fail, let it go through bankruptcy process. The other people are like, hey, it's just a loan, extend them the capital to get them through this crisis period. You know, I guess I don't have a super strong opinion, but I think the restructuring and bankruptcy process is a lot more problematic than the free market libertarians will say it is. I don't think that we should be rescuing equity holders necessarily, but I don't think we should just be allowing companies to free fall into bankruptcy without some type of rescue loan potentially being extended, because the bankruptcy process can actually cause massive job loss. It can cause firms like Virgin Atlantic to go away. And then what you might be left with is a market with only one major airline, British Airways, and then they have monopoly pricing power. So, people may not fully understand the ramifications of this process sometimes. So, I think this is all politicized, and you can have a different view on it. But I would personally just like to see them get a loan that can be paid back over time and them stay out of the bankruptcy process. And frankly, I like Richard Branson. I think he's a good guy. I think he tends to do the right things, and he tries to build businesses and create things in the world. So I'm pro Richard Branson generally.
Yeah, I tend to agree with you there. And I mean, I agree, like there is no easy answer to this, right? Like I tend to lean libertarian as well. And I'm like, yeah, free markets and all this. But if you do kind of like some kind of chart where you look at all the possible ramifications of, like you said, like what happens if you do let all the airlines fail, right? We've talked about this in past shows, but if you just let the system crumble, what does that look like really? Like there's fallout from that could make things worse on a real world level than the Great Depression. So, it's easy to say, yeah, screw the man, screw the big corporations, without really thinking through what the fallout from that could actually be.
Yeah, absolutely.
Cool. All right, let's move on. Next kind of thing, I guess we can just touch on this. Suspicions of Kim Jong-un's health. Maybe he had heart surgery. Maybe he's dead. Speculation. I don't know. I couldn't find any real facts around this. Have you guys seen anything or have any opinions or?
I'm certainly not in the loop on the, security apparatus and the intelligence community's view of it. I don't know. I tend to think where there's smoke, there's fire. There's probably something happening here, obviously, with his health. And I don't know if he's, near death or if he's just having a really bad time with his health. But this does have potential global implications. It's like the hits just keep on coming here in 2020. Whether it's equity markets, crude markets, coronavirus, you've got, all these other geopolitical things happening now. It's just, it's kind of a lot to handle.
It's a very strange time.
2020 is the worst. 2020 is the worst. It feels like it's taking forever.
Well, let's make it even weirder. So this was an article talking about housing back in January. Nikki, you were actually talking about a possible, I guess a contrarian view on the housing market, right? Because everybody's thinking, okay, the economy's, basically shut down on some level. Therefore, real estate prices are going to fall. Why might that assumption be wrong?
Well, I guess there are some supply issues right now. People are taking homes off of the market, and it obviously depends on what part of the nation, which market we're talking about here, because it's different everywhere. But for the most part, it sounds like there could be a supply issue. And if there's
pulling their listings and maybe new construction has grinded to somewhat of a halt.
Yeah. Basically, people are pulling, I don't know the exact reason why they're pulling their houses off the market. Maybe they're afraid of having to sell for too low of a price, or they're just not wanting to sell during an economic downturn or whatever it is. But I've just been hearing buzz that that's a possibility, that the low supply could actually keep housing prices kind of propped, which is not what a lot of millennials want to see right now. I think millennials are like hoping for a crash, or a lot of people are just hoping for a crash.
Yeah, it's one of those weird things where it's kind of the worst of both worlds. It's like, okay, so
exactly,
my income's going down, some asset prices are going down, but I still can't get an affordable house.
Exactly, yeah. So we'll see how it all pans out, but I guess that narrative has been circulating around that it's possible the housing market may not see the crash that everyone thinks. Granted, housing, people buying homes, that's down. That's going to be down a lot. But the actual pricing of the houses is what we're talking about here.
Yeah. So it's like it went over the next few months as we see the data, like actual net sales and new housing starts, maybe those will be way down, but maybe we won't get the waterfall of crashing prices like we saw a decade ago.
Exactly.
I don't know. We'll see. Trav, any insights on that?
Yeah, the housing market's it's going to be interesting going forward. I think you guys pretty much touched on all the major points there. I think it's going to be I think it could be one of the scenarios where it's a buyer's market for a little while, but then it kind of switches back to being a more supply constrained market, and we'll see potential for further increases in single family homes over time, and especially in areas where there's a shortage.
Interesting. Yeah, we'll keep our eye close on that one. Let's jump into some Q&A. All right, Marco is asking, what's the best tool for screening stocks? So Nikki, why don't you say yours, and then Trav, you say yours. And
Sure.
Yeah.
Well, I use FinViz to screen for stocks. I know there are more powerful screeners out there, but I love FinViz because it's just easy and quick for me, and I'm very used to it. So that's what I use.
And what are you typically screening for? So, and for anybody that doesn't know, screening is, you've got thousands of stocks out there. How do you find ones that are potentially good investments or good trades, right? So Nikki, what are you typically looking for on FinViz here?
Yeah, so I run multiple screens. I mean, I have like a dozen screens that I'll run, but I'm generally looking for top movers. So like things that have moved, top gainers, top losers. I'm screening for things that have high short interest, and like trying to find like a short squeeze, essentially. So I call that my short squeeze scan. And I'm also trying to find stocks that are coming off of lows and approaching all-time highs as well, to kind of find bottoming setups, and then trying to find breakout setups. So those are kind of the main scans that I use. And insider buying is a criteria that I use often to kind of drill down some scans when I have too big of a list and I need some more criteria.
So basically looking for stocks that are at major inflection points, either highs or lows, or some kind of fundamental thing with their, too many shorts being piled in that could create a breakout, things like that.
Yep, exactly.
Trav, what about you, man?
Yeah. So generally I have a lot of different ways that I find stocks, and I actually cover a lot of those ways in depth, like in my courses and in the investor community. But, as far as screening specifically, I pay for some premium screeners with Stock Rover. I also use FinViz occasionally for more simple screens. And yeah, I have a variety of different screens depending on what I want to look at, from, fundamental indicators, things like, insider buying, or like Nikki was saying, 52-week low list or 52-week high list, things like that. But also I'll look for, companies that are, have interesting things going on with the growth in the business, or perhaps, balance sheet issues on the short side. And yeah, I think there's a lot of different ways. Sometimes I just discover stocks by, pure accident, or by work that I've done years prior. Like a good example this week was, I was actually reading through Wynn Casino's 22-page plan about how they want to reopen their casinos in a phased approach over the next couple of months. And one of the things that they mentioned that was a primary objective is to actually screen people with thermal imaging cameras. And so I know that one of the largest manufacturers of thermal imaging cameras is FLIR, which trades publicly under FLIR. And so I was like, oh, what's FLIR been up to actually stock-wise? And I took a look at the stock. This was like before we opened up on Monday. And I was like, the stock hasn't really moved up much. In fact, it's down from 6 or 12 months ago. And I think their thermal imaging business is probably going to explode over the next 6 to 12 months. So I actually alerted some of our community members to that, and the stock's up about 20%, I think, since that alert. So nice. Yeah, I mean, it's funny how you'll find stocks sometimes. I was literally just reading Wynn's report, and they mentioned thermal imaging, and that's how I remembered, oh yeah, there's this other public company that makes those cameras. So yeah, you can find stocks in lots of different ways, whether it's screening or just through discovery. So I teach a lot of that in my courses, like I said. So
nice. Awesome. So several different tools. You can do it based on fundamentals, based on technicals, or Trav, like you said, get creative and find different ways. Big Luna asks, I have a mortgage with mortgage insurance. Can I refinance before banks stop lending and the house value comes down? I have a HELOC at 4.5%. Any ideas would be nice. So I'll take a stab at this one, since I was in the mortgage business for quite a while in my late teens, early 20s. So yeah, mortgage insurance, if you can refinance out of that, that's always a good deal. So basically what mortgage insurance is, for anybody that doesn't know, is if you put down, say, less than 20%, typically, depending on how you structure the loan, you'll have mortgage insurance, which basically insures the lender against default because you're putting less than 20% down. So as your home value increases, if you can refinance and show that you actually have 20% or more equity in your house, you can actually get rid of mortgage insurance either by refinancing or just by getting an appraisal and showing the lender that your home is worth more and you don't need the insurance anymore. Now, sometimes they'll give you pushback or they'll stall or they'll try to keep it on there. But if you have a home equity line, like 4.5% on a HELOC, which is a home equity line of credit, actually isn't that bad. That's actually historically very low. You're typically looking at prime rate plus a few. And so, 6, 7, 8% even isn't terrible on an open home equity line. But really, I think the best way if you're looking to refinance is to combine your first and your second mortgage and then have one mortgage with no mortgage insurance at a low, like 30% rate, somewhere in the 3% range. So yeah, hopefully that's helpful. Next question, let's take a look. Rogene, where do you buy gold? So I've actually got some experience in this as well. You can either buy it locally or online, depending on where you are. If you have local shops that sell gold close to spot, you really don't want to pay more than 3 to 5% above spot price. If you ever see those commercials where they're trying to sell like these rare gold coins at 3 times the cost of what spot is, that's all bullshit. It's all a scam for the most part. Especially, think about it. If they're spending money on daytime TV commercials, that you're paying for those commercials. They're not being nice by running those ads. Or there's online websites like Provident Metals, Amagi Metals. There's so many websites now that actually accept cash deposits, credit cards, or cryptocurrency. So let's actually kick this one to you, Trav. Slapstick one, I think this was a comment from your channel. What does it mean over the long run for oil? 12 months from now, provided oil recovers to $40, will USO recover too, even partially, or is there something bigger going on here?
Yeah, so this is literally, it's all sort of in flux right at this moment because I'm seeing some news here that USO did a smart thing, which is they rolled a lot of their exposure from the June contract out to July and August. So that's good. They're trying to get out of the front month contracts that are having all these issues. But I don't know if USO survives still. They may be able to hold on. Regardless, USO is facing issues from this super contango we're in. That means they have to roll those contracts to the further months as the time goes by. And right now with that steep contango curve in crude oil, that means every time they roll to the new month, it's more expensive than it was the prior month to own the same amount of crude oil exposure. So yeah, USO is facing issues with not only the prices declining in the short run, but also the contango of the curve. So I don't know if USO makes it out of this. I, again, think the CME could actually even restrict its ability to transact in the crude oil futures markets in the short run. I think that it's just an extremely problematic vehicle to try to get exposure to crude. Now, if you're looking out longer term, like if you're looking out 12 months, again, if you're trying to buy crude month oil out 12 months from now, you're going to be paying around $30 a barrel or more. Mm-hmm. So if it does recover to 40, you're not going to get as good of a return as if, you thought you were buying oil at $5 and $10 a barrel. So the market, again, is already pricing in a recovery in crude oil going out into the future. Maybe it's underpricing where crude will be. If that's your view, then you can do that. You could buy crude oil at $30 or $32 a barrel and hope that it goes up to 40 by the time that contract gets closer to expiration. But, again, these are really sophisticated entities on the other side of your trades in this market. So if you think you're just going to make an easy profit in crude, you're probably not actually going to. So I caution most people to stay away from the crude oil markets right now with all of the crazy things that are happening underneath the surface. If you really want longer term crude exposure, then it may make more sense to actually go and buy some oil and gas producers, which are still down near their 52-week lows or even their 5 or 10-year lows. So you could.
But the risk there is bankruptcy. right?
Absolutely. Absolutely. Most producers do not make money below $30 a barrel oil. So if oil stays low or even goes lower, then these companies could have solvency issues, or, even face restructuring or bankruptcy, looking 2-3 years out. So you have to be careful there too. Now, if you buy like larger diversified oil companies that have refining arms and do lots of other things besides producing oil, that may be a little bit safer way to play it, the Chevrons of the world or things like that. But again, none of this stuff is low risk, high return. You're going to have to take on some risk here. So that's just worth knowing. So this is a really dangerous time to be investing in oil and gas. Of course, longer term, potentially some upside, but you've got to really believe that, this supply demand situation fixes itself relatively quickly.
Yeah. Yeah. I mean, it just seems like one of those areas of the market that we put in the too hard category, right? Like you don't have to play all angles of the market. In fact, like I kind of look at myself this way as like a retired trader and investor, where I only come out of retirement for stuff that I really, really like, that just looks blatantly obvious. And if you're just chasing the latest fad or the latest trending topic on Wall Street bets or something like that, like you likely don't have an edge, right? And the odds of you actually losing money are a lot higher. So with that said, guys, couple of things before we wrap it up. YouTube is still doing weird things with taking down channels. So I highly encourage you guys, go to We Talk Money, get on our email list, send us a question here, subscribe to the podcast. And we are going to be hosting these videos, either self-hosting or on some decentralized platforms, maybe like Library. We're plugged up there. So just make sure if you enjoy these episodes and you get value from it, get on the email list, because who knows, we could wake up one day and YouTube says, guess what, guys, we don't like that you use the word Bitcoin, so we're going to remove your channel without telling you about it and giving you a reason why. That has been happening recently. So again, we are trying to take back control from some of these big media platforms and decentralize it and retain a direct connection with you guys. So go ahead and do that if you haven't done so already. Also, I wanted to do a quick plug for Nikki's new financial planning website and free video series. It's wealthmasterplan.com. Nikki, do you want to talk a little bit about what this is and maybe who this is for?
Yeah, basically what I've done is I've created some content to help teach people how to build a holistic, financial plan for themselves. I think financial planning has been out of reach for a lot of people, comprehensive financial planning. And so I built this program to kind of help teach people how to look at every aspect of their financial lives, things that they may not have thought about before, questions they may not have asked themselves before. So it's if you're interested in learning more about comprehensive financial planning, check that out, wealthmasterplan.com. for the free video series.
Yeah, I think it's great, because there are a lot of people that maybe make a lot of money as an entrepreneur, or they're really skilled investors or traders, but when it comes to actually putting together a plan that encompasses like all angles, maybe they're leaving a lot of money on the table with, I don't know, things like taxes or not structuring their insurance properly. Well, I guess what are some of the major problems or kind of holes that people have that maybe there are blind spots for them?
I think that with a lot of people, it's taxes. I think just so many people don't understand how taxes work and how they can maximize tax savings while also doing like active investing. You can actively invest your retirement accounts, get the tax deduction. You can increase tax deductions if you're self-employed or you own a business. There's a lot of strategies that people aren't aware of. Or they just don't take the time to understand it. So they think, oh, it's too complicated for me, I'm not going to bother with that. The thing is also with learning about things like taking advantage of capital gains rates versus short-term tax rates, with things like how you manage your trading, how you manage your investing, right? Like if you know that you can strategize that a little bit and help save on taxes, things like that, I feel people could improve their strategy a little bit more. But
Yeah.
also the insurance stuff. I mean, there are a few strategies there that people may not be aware of, and just kind of having an overall plan for everything. And I try to engage people and have them ask themselves questions that they may not have thought about before, so to speak.
I think that's powerful because, I mean, we've even seen that in the community with some of our crypto guys that made a ton of money over the past 5 years, but a lot of them didn't think about the tax implications of their trading strategies. And to their credit, I mean, a lot of the stuff was unclear, so they didn't even know what the tax rules were until it was like after the fact. But going forward, it's like if you know how to structure that foundation, you can set up your strategies and your businesses in a way that help you maximize tax savings and, you know, optimize your investments and optimize your insurance and really make sure you're protected from all angles too.
Yeah, that's the other thing too on the investment optimization side, is making sure that you're exposed to the right, you know, assets, and you're not overexposed to one thing versus another thing. That's another thing I think people may overlook a little bit, especially people that are heavily concentrated in things like crypto, or maybe just heavily concentrated in company stock or something, whatever it is. So just learning how to think outside and diversify a bit more.
So basically create their wealth master plan. I love the name, by the way. Awesome. All right. Well, hey guys, thanks for joining us today. Hope you got a lot of value from this. Feel free to go to wetalkmoney.com, subscribe to the show. Feel free to join us in the wealth building community at the Skill Incubator. Reach out if you have any questions to any one of us, and we will see you in the next episode. Take care, guys.